The automotive world was shaken to its core when Stellantis, the global powerhouse behind Jeep, Dodge, Ram, Chrysler, and Peugeot, unleashed a move so bold that it sent shockwaves through Detroit, Wall Street, and every dealership across America. In a year already defined by economic uncertainty, rising tariffs, and EV market turbulence, Stellantis didn't just react, it rewrote the playbook. The announcement came like a thunderclap, a sweeping restructuring strategy that combined cost-cutting, electrification acceleration, and dealer reform, all launched within weeks of its Q3 report. On paper, Stellantis looked unstoppable, global shipments up 13% year-over-year, fueled by a 35% rebound in North American deliveries and an extraordinary 122% surge in Jeep Wagoneer sales. Yet behind those glowing numbers lay a brewing storm. CEO Carlos Tavares admitted that while volume was surging, profits were plunging, with a €2.3 billion net loss recorded in just the first half of 2025, a direct result of tariffs, overproduction in Europe, and massive investments into future EV infrastructure. This paradox, record sales but historic losses, is what flipped the market on its head. Analysts and competitors scrambled to understand what Stellantis was really doing. Many believed the company was playing the long game, accepting short-term pain to dominate the next decade. Others saw it as a desperate gamble. Stellantis had just slashed over 100,000 vehicles from its U.S. dealer inventories, signaling a strategic shift away from bloated lots toward a leaner, more digital, build-to-order system, a move eerily reminiscent of Tesla's direct sales model. The result? A chain reaction across the American auto industry. Ford and GM were forced to reassess production, fearing dealer backlash and mounting unsold stock. Meanwhile, Stellantis' announcement of up to $8,000 off select Jeep and Ram models in October 2025 only added fuel to the fire. Consumers flooded showrooms, not realizing that these deep discounts were part of a calculated push to clear legacy inventory before a massive wave of new hybrids and EVs lands in 2026. The shock didn't stop there. Tavares also hinted at an upcoming Stellantis-Foxconn collaboration to overhaul vehicle software and onboard AI, a partnership that could redefine smart mobility. Suddenly, Stellantis wasn't just another automaker, it had become a tech-forward disruptor. Industry experts compared it to Apple's first iPhone moment in 2007, bold, risky, and world-changing. Competitors like Ford's Jim Farley and GM's Mary Barra were forced into defense mode, issuing emergency internal memos about cost containment and accelerated EV launches. Even Toyota, usually calm amid chaos, began hinting at increased hybrid production for the U.S. market to stay competitive. But what made this move truly historic wasn't just the numbers, it was the timing. With the U.S. auto market already wobbling under pressure from high interest rates and a credit crunch, Stellantis' aggressive shift hit the system like a lightning bolt. Car repossessions in the U.S. soared past 1.7 million units, the highest since 2009, while subprime loan delinquencies exceeded 6%, clear signs that consumers were reaching their financial limits. Yet Stellantis' deep discounts and flexible payment plans turned this crisis into opportunity, giving middle-class buyers a reason to return to the market. For many Americans priced out of the EV race, Stellantis suddenly looked like the hero brand offering both affordability and innovation. By the time Wall Street digested the full scope of Stellantis' plan, the dominoes had already started falling. Shares of rival automakers dipped as investors shifted focus toward Stellantis' long-term strategy. Dealerships reported surging foot traffic, social media buzz exploded with talk of Stellantis steals, and analysts began calling the company's tactics the first real disruption of the U.S. auto market since Tesla. Whether it was bravery or brilliance, Stellantis had flipped the table on an industry built on predictability, proving that in 2025, the rules of the game have changed. If there was one move that truly rattled the U.S. auto industry, it was Stellantis' sudden and massive inventory purge, a bold decision to slash more than 100,000 vehicles from American dealership lots almost overnight. On the surface, this looked like corporate suicide. Why would a major automaker intentionally pull cars from showrooms when sales were finally rebounding? But behind that shocking headline was a masterstroke of strategy, one that revealed Stellantis' plan to completely restructure how vehicles are sold, priced, and delivered in America. For decades, the U.S. auto business has relied on an outdated model, flooding dealerships with unsold stock, forcing aggressive discounts, and eating the costs of overproduction. Stellantis decided it was done playing that game. By cutting inventory, the company wasn't retreating, it was declaring war on inefficiency. The timing couldn't have been more dramatic. In early 2025, U.S. automakers were drowning in unsold vehicles. Industry analysts reported that the average dealership had more than 80 days' worth of inventory, well above the pre-pandemic average of 60 days. Rising interest rates meant that dealers were paying more than ever in floor plan financing costs, essentially losing money just to keep vehicles parked on their lots. Stellantis CEO, Carlos Tavares, saw the writing on the wall. His team initiated what insiders call Project Reset, a nationwide plan to cut excessive stock, modernize logistics, and shift toward a build-to-order sales model, similar to Tesla's. By doing so, Stellantis not only reduced operational costs but also regained control over pricing, creating a sense of scarcity that boosted perceived value among consumers. Almost immediately, this move sent shockwaves through Detroit. Ford and GM executives reportedly held emergency meetings to analyze Stellantis' approach. Dealers were furious at first, many accused Stellantis of starving them of inventory. But within weeks, something unexpected happened: prices stabilized. Instead of constant markdowns and bonus cash offers, the reduced supply helped hold sticker prices steady, protecting profit margins that had been eroding for years. Stellantis' gamble was working. Jeep, Ram, and Dodge models that once sat idle for months began selling faster. The company even reported a 15% improvement in average transaction prices by mid-2025, despite overall sales volume dropping slightly due to reduced availability. But the inventory purge wasn't just about economics, it was about positioning for the future. Stellantis knew that 2026 would be a pivotal year, with its next-generation EVs and hybrids set to hit the US market. To prepare, the company had to clear space, both physically and financially. The reduction in unsold gas-powered inventory freed up billions in working capital, which Stellantis redirected into battery production, software systems, and dealer training for EV servicing. At the same time, Stellantis announced that its future models would feature a unified, customizable digital architecture, allowing buyers to configure cars online and track production in real time, cutting wait times from months to weeks. This move signaled the end of bloated dealer lots and the beginning of a direct-to-customer revolution. The reaction from the broader auto world was a mix of awe and alarm. Ford dealers began privately pressuring executives to reduce their own inventories, while GM supply chain analysts started modeling Stellantis' strategy for internal reports. Even Toyota and Honda, long known for lean operations, acknowledged that Stellantis had raised the bar. Meanwhile, Wall Street took notice. Analysts from Morgan Stanley praised the decision as painful but visionary, noting that Stellantis was the first legacy automaker to truly modernize its U.S. sales system. Consumers, on the other hand, had a more complicated response. In the short term, buyers noticed fewer vehicles on lots and longer waits for certain models. Yet, Stellantis countered this frustration with massive cashback deals and low-interest financing, including up to $8,000 off select Jeep and Ram trucks, 0% APR for 48 months, and even no payments for 90 days on certain models through late 2025. The message was clear: Stellantis wasn't pulling out of the US market, it was recalibrating it. CEO Carlos Tavares framed the challenge as an opportunity: adapt or vanish. Stellantis began rerouting supply chains, shifting component sourcing from tariff-heavy zones in Asia to new plants in North America and Eastern Europe. The company poured billions into expanding battery and semiconductor production in Mexico and Canada, a move that not only reduced exposure to trade volatility but also aligned with the U.S. Inflation Reduction Act's incentives for domestic and nearshore manufacturing. It was a risky strategy. Costs rose sharply in the short term, and Stellantis' H1 2025 report showed a net loss of €2.3 billion, largely due to restructuring and tariff shocks. But behind those grim numbers was a longer-term play: to insulate Stellantis from global instability and position it as one of the few automakers capable of thriving in a post-tariff world. Stellantis' response was nothing short of a masterclass in resilience. While competitors hesitated, Stellantis doubled down on regional production. The company accelerated its Made in North America initiative, a blueprint to build most vehicles for the U.S. market within tariff-free zones. Ram truck assembly was boosted in Michigan and Mexico. Jeep and Dodge production was strategically redistributed to minimize cross-border costs. At the same time, Stellantis partnered with multiple battery startups to establish new gigafactories in Canada and the Midwest, reducing dependency on Chinese imports. The result? By the third quarter of 2025, Stellantis had successfully offset a large portion of tariff-related expenses through local manufacturing and supply diversification, regaining stability faster than its rivals. Meanwhile, the political side of the equation was equally explosive. Lobbyists from major automakers flooded Washington, urging the government to ease tariffs or offer more subsidies. But Stellantis leadership took a different route. It embraced the chaos. The company's executives publicly supported the idea of competitive self-reliance, a term that quickly became a buzzword in automotive circles. By framing its struggles as part of a broader economic evolution, Stellantis positioned itself as the brand willing to endure short-term pain for long-term independence. This narrative resonated with investors and policymakers alike, earning Stellantis unexpected goodwill and a stronger reputation as a future-proof manufacturer. Still, the cost of survival was enormous. Tariff expenses, currency fluctuations, and retooling costs pushed Stellantis operational spending into the trillions of dollars globally when including multi-year commitments. But these were not reckless expenditures, they were calculated investments in autonomy. As trade tensions between the US, China, and the European Union continued to escalate, Stellantis' decision to build a self-contained supply chain ecosystem began to look prophetic. When other automakers faced shutdowns due to missing parts or material shortages, Stellantis' new hybrid logistics network kept production running with minimal delays. The irony of it all? What started as a global crisis may have become Stellantis' greatest advantage. While Ford and GM were forced to trim forecasts and lay off thousands, Stellantis emerged as the most adaptive automaker in the Western Hemisphere, a company that had turned tariffs into tools and adversity into armor. Investors began to recognize the shift. Stellantis stock, which had dipped early in the year, began to rebound as analysts projected stronger margins in 2026 thanks to regional cost savings and supply control. In the end, Stellantis' handling of the tariff storm wasn't just about survival, it was about redefining what resilience looks like in a fractured global economy. The company had weathered the trade wars, absorbed multi-billion-euro hits, and still managed to lay the groundwork for a stronger, leaner future. By proving it could thrive under the weight of tariffs and geopolitical tension, Stellantis didn't just flip the US auto market, it rewrote the rules of global competition. In 2026, Stellantis will unleash what industry experts are calling the triple wave, 3 flagship vehicles that could redefine electric mobility: Ram 1500 Ramcharger PHEV, the pickup that could end range anxiety forever. With its hybrid electric system delivering 690 miles of total range and up to 663 horsepower, this truck is built to dominate the work and adventure market. It's the first in its class to blend plug-in hybrid tech with real truck capability, offering a perfect balance of power and practicality. Dodge Charger Daytona EV, the world's first electric muscle car, is finally coming to dealerships. Capable of 0 to 60 miles per hour in just 3.1 seconds, it doesn't just revive American muscle, it electrifies it. Priced around $39,995, it's designed to attract both car enthusiasts and EV newcomers, undercutting Tesla's Model S and Ford's Mach-E GT, Chrysler Airflow, Stellantis' flagship electric crossover. Sleek, efficient, and software-driven, the Airflow offers up to 435 miles of range and features full AI integration with Smart Cockpit, allowing voice-controlled navigation, predictive maintenance, and over-the-air updates. Combined, these models represent Stellantis' all-out assault on every major market segment: trucks, performance cars, and family EVs, at prices $5,000 to $10,000 below most competitors. The strategy is simple yet revolutionary: make EVs desirable, attainable, and profitable all at once. While most automakers are still struggling to perfect lithium-ion technology, Stellantis is leapfrogging into the next phase: solid-state batteries. Through its partnerships with Factorial Energy, US, and ACC, Europe, the company plans to debut solid-state cells in 2027 that deliver up to 700 miles of driving range per charge, twice the energy density of current EV batteries. Faster charging times, reaching 80% in under 10 minutes. 50% lower degradation over the battery's lifespan. To achieve this, Stellantis is building 5 new gigafactories, 2 in Europe, 2 in North America, and 1 in South America, all operational by late 2026. Each facility will be capable of producing over 40 GWh annually, securing Stellantis battery independence and protecting it from global supply chain volatility. This battery ecosystem will power not just its cars, but its future energy division, Stellantis Energy, which will offer home power storage systems, solar integration, and EV-to-grid solutions, turning Stellantis into a full-fledged energy provider, not just a carmaker. Stellantis' 2026 playbook is laser-focused on deepening its global footprint. With 14 major brands across 130 countries, the company plans to leverage its diverse portfolio to achieve double-digit growth in every region. North America: consolidate market share by pushing hybrid and EV trucks through aggressive financing, 0% APR for 60 months and $5,000 trade-in bonuses. Stellantis aims to surpass GM in total U.S. truck sales by the end of 2026. Europe, expand low-emission city vehicles under Peugeot, Citroën, and Fiat, focusing on affordability. The new Fiat Panda EV and Peugeot E208 Refresh are projected to dominate the sub-$25,000 electric segment. Latin America, continue leading with flex-fuel hybrid systems, allowing vehicles to run on ethanol and electricity, perfect for Brazil's infrastructure. Stellantis aims to hit 35% market share by mid-2026. Asia-Pacific, through its Leapmotor partnership, Stellantis will launch affordable EVs tailored for India and Southeast Asia, priced as low as $19,999, a potential game-changer in developing markets. Africa and Middle East, expand solar-powered charging networks and local assembly plants, creating new green jobs while promoting affordable mobility. This multi-continent approach ensures Stellantis can weather regional slowdowns while maintaining global growth momentum, something even Toyota struggles to achieve consistently. Stellantis' next major leap isn't mechanical, it's digital. The smart cockpit platform, developed with Foxconn and Amazon Web Services, will power all 2026 Plus vehicles with features like real-time diagnostics and predictive maintenance, AI-driven route optimization for fuel and battery efficiency, seamless integration with smart homes and wearable devices, subscription-based upgrades, performance boosts, infotainment packs, autonomous features. By 2027, Stellantis expects over $20 billion in annual digital service revenue, turning every vehicle into a long-term software platform. This diversification will help the company maintain profitability even if hardware sales fluctuate. Stellantis' environmental strategy goes beyond electric vehicles. The company has committed to being carbon net zero by 2038, one of the boldest targets in the global auto industry. To get there, it's implementing 100% renewable energy across all factories by 2027. Full recycling of all end-of-life EV batteries. Reduced emissions from logistics via electric freight trucks and ships powered by bio-LNG. These sustainability measures not only reduce costs in the long run but also attract ESG-focused investors. Stellantis has already secured $4.2 billion in green financing to accelerate these initiatives. Financial power and investor confidence. After dominating Wall Street in 2025, Stellantis is entering 2026 with unmatched financial stability. Its $59 billion cash reserve and rising dividend yield position it as the most financially secure automaker globally. The company plans to allocate $10 billion for R&D on autonomous driving and AI, $8 billion for global factory modernization, $3 billion for expanding its energy division. Meanwhile, Ford and GM continue trimming budgets, and even Tesla faces shrinking margins due to price wars. In contrast, Stellantis' financial model, built on efficiency, scale, and affordability, ensures sustainable profitability across all markets. Stellantis' vision of the future isn't about exclusivity, it's about empowerment. Its upcoming campaign, Drive the Future, focuses on giving every customer access to premium technology at a working-class price. Early leaks from internal memos hint at upcoming subscription-free EV features, lifetime battery warranties, and personalized vehicle tuning through the Stellantis app. By 2030, Stellantis plans to surpass Toyota as the global leader in volume, revenue, and sustainability. Its 2026 to 2028 targets are bold but achievable: sell 8.5 million vehicles per year globally. Achieve 50% EV/hybrid mix across all brands. Generate $25 billion annually from digital and energy services. Expand its workforce with over 50,000 new green jobs worldwide. If achieved, these numbers would make Stellantis the largest, most diversified, and most technologically advanced automaker on the planet. In just a few short years, Stellantis has transformed from an underestimated merger into the driving force of the global automotive revolution. It mastered affordability without sacrificing innovation, conquered Wall Street without losing its industrial soul, and bridged continents through efficiency, vision, and bold execution. As 2026 dawns, one truth stands out: Stellantis didn't just flip the auto industry, it rewrote the rules for its future. While others play catch-up, Stellantis is already paving the highway to a new world of mobility, one where technology, sustainability, and accessibility drive hand-in-hand toward a future built for everyone. The race isn't over, it's just begun. And Stellantis is already miles ahead. The world of automobiles has seen giants rise and fall, but never like this. Stellantis didn't just build cars, it built a revolution. What began as a quiet merger between legacy brands turned into an unstoppable global force that has flipped the US auto market on its head. Today, the streets tell the story: Fords waiting on lots, Chevys stacking up in warehouses, and Ram trucks driving off faster than dealers can restock. The US auto market is in total meltdown, and Stellantis is the reason why. From shock price cuts to mind-blowing EV tech, from record-breaking range to relentless innovation, this company isn't following trends. It's creating them. In just a few years, Stellantis went from an underdog to the industry's most disruptive titan. Its upcoming lineup, the Ramcharger, the Dodge Charger Daytona EV, the Chrysler Airflow, they're not just vehicles, they're declarations of dominance. Each one engineered to undercut rivals, outperform expectations, and redefine what consumers demand from a modern machine. The result? Ford and GM are slashing prices to stay alive. Tesla is losing ground in markets it once owned. And every automaker is now scrambling to match Stellantis' bold mix of affordability, technology, and global reach. But here's the truth: Stellantis isn't just winning the numbers game, it's changing the rules of the road. While others fight for survival, Stellantis is building the future: solid-state batteries, AI-powered dashboards, carbon-free factories, and digital ecosystems that will turn cars into intelligent companions. The message is clear: the automotive war of the century has begun, and Stellantis fired the first shot. The industry is melting down, the market is reshuffling, and the next era of mobility is being written right now. So buckle up, because what's coming next will redefine driving forever. Stellantis didn't just flip the auto industry, it rewired the world's engines. This is the new age of power. The new era of motion. The Stellantis era.